I thank Mint for giving me the opportunity to address this August gathering. I thought I would use this opportunity to reflect on the current trends and some of the opportunities and challenges and the way forward around capital formation in the economy. First, I will look back at the very positive story of all-round flows, both from investors and now even from issuers, trends that the ecosystem should recognize and celebrate. Second, I will argue that there is no room for any complacency, that opportunities for sustained capital formation still abound, as do challenges. The whole ecosystem, all of us put together, have much to do to maintain and grow the trust and faith of the ecosystem. Finally, I will present SEBI's approach to fostering trust while growing the ecosystem, as exemplified in recent examples around FPIs, alternate investment funds, and equity derivatives. I will then suggest some takeaways for the future. A key positive feature of the last few years, particularly after COVID-19, has been the rise of the domestic investor. While we talk of mutual fund flows a lot, what we don't realize is that the flows into AIFs, alternate investment funds, and PMSs, portfolio management schemes, have also risen quite sharply. Let's start with the investments into domestic mutual funds. During the 6 years between fiscal year 15 and fiscal year 20, net risk-oriented investor flows into mutual fund schemes, which I define here as flows into equity-oriented schemes and into hybrid schemes excluding arbitrage funds and into equity index funds and ETFs, averaged around 1.4 lakh crores per year. This was between FY15 and FY20. After COVID-19, during the 3 years between FY22 and FY24, this number rose sharply to 3.2 lakh crores on average a year. So more than double during that particular year, these 3 years. In the current year, fiscal year 25, for the 9 months until December 2024, this number has already hit a record of INR 4.8 lakh crores. Note that this number is over 30% of the incremental time deposits booked by banks during the same period. So in the 9 months itself, we've hit a record for the year. Of course, we could have negative flows in the next quarter, but the fact is, this is a record period of flows for this FY25. On the supply side of the equation, between FY22 and 2024, the supply of fresh paper by listed companies, that is, issuances excluding offer for sales by promoters or by other shareholders, averaged around 1.5 lakh crores per year. I have in the past expressed apprehensions that this supply of paper may not be keeping pace with the rise in demand for paper, suggesting the risk of asset inflation and suboptimal capital formation. I'm happy to note, however, that during the current fiscal year FY25 till December, supply of fresh paper by companies, excluding OFS, has already risen to an all-time high of rupees 2.9 lakh crores. Across all sources, the gap between demand and supply has narrowed this year, even as both sets of numbers, the demand as well as the supply for paper, has actually risen quite a bit. For capital markets seeking capital formation, this is indeed the best possible outcome, rising demand for and rising fresh supply of securities. Alongside mutual funds, there has been a significant rise of flows into alternate investment funds over the years, something that is perhaps less appreciated. Remember, this is supposed to be an over-regulated set of people. As of September 2024, the net funds raised by AIFs from investors crossed 5 lakh crores, with a creditable increase of 1.1 lakh crores on a year-on-year basis. That's a 29% increase in the funds raised from large investors. The year-on-year change crossed 1 lakh crore for the first time during that period. Around 65% of the net funds raised by AIFs are from domestic investors. Similarly, the total commitments made by investors into AIFs have risen to 12.4 lakh crores as of September 2024, with a rise of rupees 2.9 lakh crores or 30% on a year-on-year basis. Somewhat comparable, you will note, to the flows, incremental flows into the mutual funds during that period. Commitments have increased by about 31% on a compounded annual growth rate basis for the past 5 years. We don't seem to realize this, but actually flows into mutual funds, particularly in terms of commitments, have risen to levels comparable to mutual funds at this point in time. Let me now turn to the opportunities and challenges going forward. The trends in demand and supply is certainly remarkable and deserves celebration, and every stakeholder in the ecosystem deserves their share of praise for what is coming through. However, there is simply no room for any complacency. First, opportunities to grow the pot still abound. While we have over 13 crore unique investors in the SEBI ecosystem today, a number that has tripled from 4.4 crores, just 4.4 crores 5 years ago, CBDT data suggests that over 60 crore Indians have linked their PAN number with Aadhaar. That's the catchment area potentially for the entire securities market ecosystem. On the flip side, there are challenges as well. We have a fundamental responsibility to preserve and grow the trust of the rising number of investors in the capital markets ecosystem. Any egregious type 1 errors, such as governance failures, technology failures, market manipulation, or fraud, can endanger trust and kill the goose that's laying the golden eggs. At the same time, and I've said this to Mr. Damodaran here, one of our mentors in many ways of the SEBI ecosystem, we're also conscious that even as we take steps collectively to prevent or rapidly address type 1 errors, we must ensure that regulations do not come in the way of capital formation. That would constitute a type 2 error. In statistics, it is not possible to minimize type 1 and type 2 errors simultaneously. I suggest, however, that in our regulatory approach, if we apply our minds collectively and constructively, we can find win-win solutions where we minimize both type 1 and type 2 errors. I will try and present some practical examples of this from our recent experiences in FPIs, in AIFs, and in equity derivatives. Let me turn to FPIs. Since the time that we opened our country to foreign portfolio flows 3 decades ago, we've had periodic instances of concerns being raised around the identity of investors behind some FIIs, FPIs, P-notes, and now overseas derivative instruments. If in fact there was circumvention of SEBI's stipulations around minimum public shareholding or the stipulations around substantial acquisitions of shares and takeovers, that would indeed constitute a type 1 error. One way to detect this would have been to stipulate that every foreign investor must disclose all details of their ownership, control, and economic interest to the last cent on a look-through basis. However, instituting such a requirement across all FPIs would have led to large type 2 errors. Giving full details of all investors can be extremely onerous for even legitimate investment managers and funds of international jurisdictions where structures such as omnibus structures exist. In August 2023, with the approval of the SEBI board, we instead introduced a focused and clinical risk-based approach to mandating extensive disclosures. In respect of possible MPS and SAST circumvention, first, Only FPIs that met a concentration criteria of more than 50% of their AUM invested in a single corporate group were considered for additional disclosures. Even here, no additional data was sought from funds such as sovereign wealth funds, public retail funds, and exchange-traded funds, where there was regulatory comfort around their identity on a trust but verify basis. Others, however, were required to provide granular disclosures on a look-through basis. Similarly, there was a size criteria for granular disclosures by FPIs with AUM of over 25,000 crores. This was to guard against the potential circumvention of Press Note 3 stipulations by FPIs with large Indian equity portfolios, with the potential to disrupt orderly functioning of Indian securities markets by their actions. Once again, some funds, such as sovereign wealth funds, were exempted from additional disclosures based on objective and transparent trust but verify considerations. Beyond FPIs, these requirements have now been extended to ODI, which is the erstwhile P notes as well. Now the question is, how has this approach performed on type 1 and type 2 errors? While history will tell us what the answer is, let me try and offer you at least our immediate perspective. First, the specific and targeted FPIs that were required to provide additional disclosures but were unable to do so had to exit the country by September 9th, 2024 to avoid stringent penalties. Note that FPI flows were a significant net positive during the period Jan 2024 and September 2024. We can also confirm that notwithstanding some unnecessary and baseless speculation from some quarters, any FPI outflows after September 2024 cannot be attributed to the circular. Finally, we can also confirm that to date, no FPIs have been required to cut positions or exit under the 25,000 crore size criteria, which is to prevent circumvention of PN3 stipulations. I have to compliment the ecosystem of custodians, DDPs, FPIs, depositories, and other stakeholders who work closely with SEBI to ensure that we minimize type 1 and type 2 errors through all of this. I think this has gone a long way in strengthening the trust in the ecosystem without coming in the way of legitimate investments. In fact, the feedback from FPI is that they actually believe the system has become stronger and more trustworthy after these stipulations have come in. And it's not been at the cost of actual legitimate investments coming into the country. Separately, through 2024, alongside this implementation, SEBI has also worked closely with all stakeholders to bring about additional ease of doing business for FPIs. Thanks to our collective efforts, processes have been improved so that, like domestic investors, now access their funds on the day of settlement itself, a significant improvement over the past. This change we brought about in September 2024. A common and transparent SOP for FPI registration has been put in place, and the registration process has been and will continue to be simplified. Depositories have built trackers allowing us to have an overview of pending registrations. SEBI now has an FPI outreach cell that has interacted with over 1,000 FPIs in this financial year to date, including to address their specific problems. I'm very happy to report that we are seeing around, on average, 130 new FPI registrations per month in FY25 so far, nearly twice the number of FY24. The numbers have almost doubled of the FPI registrations. Let me now turn to AIFs. We've already noted that this industry is now growing significantly, and the annual rise in AIF investment commitments is of a similar order of magnitude as the growth in the mutual fund ecosystem. You may recall that around 2 years ago, SEBI first highlighted a significant type 1 error surrounding AIFs. We had found that a significant chunk of AIFs appeared to be structured to circumvent existing financial sector regulations, including RBI regulations, FEMA regulations, and IBC stipulations. Through 2024, our approach in collaboration with industry was to address this concern, which effectively translate while ensuring that we minimized any collateral damage of type 2 errors. I'm very happy to report that we have largely addressed this issue. In fact, over the last 6 months, we have been pivoting to trying to leverage the gains of trust that we have had to improve ease of doing business for the overall ecosystem. A framework is now in place, which is a solution that we came out with, which effectively translate into a clear and specific set of do's and don'ts that AIF investment managers must follow to guard against any such circumvention. These do's and don'ts have been put together by the industry itself via the Standards Forum for AIFs in consultation with SEBI. They have been designed to be focused and targeted and as simple as possible. As an example, AIFs with significantly large or even one single investor are required to adhere to the simple principle of ensuring that the investor is not prohibited from making the ultimate investment directly, which is a person who is not allowed to make an investment directly should not be doing so via the AIF. A simple principle if you have large investors in the fund. In addition, both the assets of AIFs and the units of investors are now largely in dematerialized form. It's a unique ecosystem, unique to in the world, offers a significant benefit to investors while improving regulatory visibility all around. With the contours of this solution now in place to address the type 1 error alluded to above, the resulting increase in all-round trust has allowed all of us to pivot towards taking steps to improve ease of doing business. Tranching, a route that was in the past misused by some AIFs to circumvent RBI regulations, has now been allowed for certain sets of investors. AIFs have also been allowed to pledge their equity investments in infrastructure sector so that their investee companies can raise debt. AIFs have also been given significant flexibility to deal with unliquidated investments beyond the expiry of the fund. In addition, there is now a framework for erstwhile VCFs, which were in violation of regulations with unliquidated investments, to migrate to the AIF regime seamlessly. The process for accreditation of investors has also been considerably simplified. I believe that popularizing the concept of accredited investors can further contribute to the growth of the AIF and angel fund ecosystem. In summary, I want to emphasize that while 2 years ago we were talking about AIFs being a vehicle for circumvention of existing regulations, that issue has now been resolved the whole of last year, we believe. And since then, leveraging on that, we are actually building measures or taking measures to improve the ease of doing business for. So the pivot has changed from tackling type 1 errors to actually tackling type 2 errors now. Finally, a quick word on derivatives, FNO and the market infrastructure institutions. I have recently spoken of SEBI's approach towards equity derivatives, so I will not elaborate on this subject today. Suffice to say that I believe SEBI's approach towards equity FNO exemplifies our approach to try and minimize both type errors. There was a potential type 1 risk here in the form of consistent and egregious small investor losses and the potential for structural risk vulnerabilities in the ecosystem. Our extensive and detailed consultations helped identify the main root cause issue, clinically and specifically, as specifically egregious overtrading in index options on expiry day. We were not painting the entire FNO space with one brush. We were only focusing on the specific issue of index options trading on expiry day, which is what we found was egregious. In October 2024, we took a series of 6 steps that were largely designed to address this specific issue surgically without painting all of FNO with one broad brush. Even as we judge the impact of these steps over the next few months, based on the trust that we now have in the ecosystem, we are looking at ways to grow the F&O ecosystem so that it contributes to price discovery, market depth, risk management, and ultimately to capital formation. Make no mistake, SEBI believes futures and options are essential for sustained capital formation in this country. We will look to improve the risk metrics in F&O and consider both tactical and structural steps to reduce the risk and fear of any manipulation across cash and derivative markets. A quick side note on this issue. As our recent orders have demonstrated, between exchanges and SEBI, we have strong surveillance mechanisms. While we can never say that we are perfect, we are watching and learning all the time. We will continue to invest in surveillance to safeguard trust in the ecosystem. Another side note, it is worth noting here that our MIIs, which are the exchanges, clearing corporations, and depositories, are the first line regulators charged with ensuring investor protection and market integrity. Amongst other things, they are required to ensure adequate disclosures by issuers, conduct appropriate surveillance to deliver a free and fair market bereft of unfair trading practices, manage risks and operations to deliver smooth clearing and settlements, monitor the conduct of brokers and other intermediaries, and ensure that market technology platforms and ledgers are fair, secure, reliable, and resilient. Indian MIIs have a unique operating model in that they are empowered by law to regulate their own paying clients, such as listed companies, trading members, clearing members, and depository participants. They are required to primarily focus on the investing public as a public utility while ensuring the integrity of capital markets. At the same time, they are also commercial entities in competition with each other, and the larger MIIs in equity markets now enjoy high operating margins with profit before tax to income margins well in excess of 50%. To preserve and grow the trust in the ecosystem, it is crucial that MIIs, as is required by law today, continue to give primacy to ensure technology and operational resilience, risk management, and ensuring compliance in investor interest over business considerations. In a sense, when questions around areas such as F&O and SME IPOs come up, MIIs should be the ones taking the lead in finding appropriate solutions that are in the interest of the investing ecosystem over their own commercial considerations. We have collectively taken some steps to ensure this, including closely with the public interest directors of the boards of MIIs and ensuring that crucial key management personnel of the MII have a dual reporting to both the MD as well as the relevant board committees. Further steps may be needed to strengthen the framework of governance in MIIs and ensuring that they're the first-line regulators first. We've also proposed some possible ways to strengthen the independence of clearing corporation and ensure their continued focus on risk management. I had promised to put you to sleep. I now promise to wake you up with this very short announcement that we have now come to the conclusion. Our funds ecosystem has grown significantly in recent times with substantial growth in both issuances and investments. While we may have specific issues and concerns at the overall level, we must acknowledge that something good is indeed underway. There are opportunities and challenges ahead. One key imperative is to preserve and strengthen the trust in the ecosystem. We all know that the financial markets ecosystem entirely relies on trust. Type 1 errors such as governance failures, technology failures, market manipulation, or fraud can endanger trust and kill the goose that's laying the golden eggs. We must collectively continue to guard against this. This is too big a risk to be left to regulators alone. We are also conscious of type 2 errors, where in our zeal to minimize type 1 errors, we could create an ecosystem that comes in the way of legitimate and desirable capital formation. For our part in SEBI, I can promise you that we will look at both risks very closely and leverage extensive consultation to try and minimize both together. The topical examples that I've tried to provide today around recent events in FPI, AIF, and FNO hopefully stand testimony to this approach. In turn, I ask that all stakeholders must strive to be trusted advisors who focus on both errors as well, equally. On type 1 errors, when you see something, please say something. On removing type 2 errors, when you make your suggestions, please think about how the risks of any resultant type 1 errors can be mitigated. Here's to us working collectively to ensure sustained capital formation in our country. Thank you once again to Mint for this opportunity and for your patience.